Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday, the 15th of June, 2020, and we're going to share our thoughts with you concerning money printing and the future value of gold. Now, earlier today we had a chat with a UK economist who is also a former hedge fund manager and derivatives expert. And we asked him the question, why, when countries are devaluing their currencies through money printing and various forms of quantitative easing, are we not seeing gold prices rise through the roof? Now, we have our own views on this, but it was interesting to hear his view. Now, we're paraphrasing here, but it all boils down to a lack in the belief of gold as being an appropriate medium of exchange. You see, he accepted that gold is a store of value, that is unquestioned, but is a difficult form of medium of exchange involving general transactions. Now, he said that when you look at, say, Bitcoin or other cryptocurrencies, they arguably perform both objectives, and in his view, will continue to do so well into the future. He alluded to the fact that the investment community in the main does not take gold as being a sufficient serious form of investment beyond hedging purposes, and has difficulty viewing it as a futuristic currency. So, when we look at the price of gold, which today stands at $1,726, or at least at the time of publication, an ounce, we can see that over a 10-year period, it has risen by some 40%. If we look at Bitcoin, for example, which admittedly is well down from its all-time high, currently it is trading at $9,412. Now, when we consider that Bitcoin was first properly traded in 2010, when a Bitcoin miner bought 2 pizzas from a Papa John's in Florida for, wait for it, 10,000 Bitcoin. So that would place, arguably, the value of each pizza today somewhere in the region of $47 million. Now, more seriously though, expensive pizza. More seriously though, Bitcoin really started to take off in 2013, when its price was just $13.50. And in 2017, December, it actually nearly touched $20,000. And those of us who remember, just a few years ago, people were talking about $100,000 Bitcoin and some even $1 million Bitcoin. Now, many analysts believe that to some quite significant extent, cryptocurrencies were actually taking the place of gold as an alternative form of currency. And to some extent, this adversely affected what one would have expected to see through the last decade, and that is an appreciable rise in the price of gold. Now, realistically, gold began its price rise, which then continued to this day from around October 2018, certainly in dollar terms. And in spite of trillions of dollars of financial stimulus, and the US debt clock now exceeding $26 trillion, one really does have to ask the question, why is gold, in spite of recent rises, still some $170 or so off its all-time high? Now, of course, other countries will explain that this is more to do with the strength of the US dollar, as in many of those countries, gold has reached continued all-time highs this past 12 months. And a dollar index, currently at 96.7, whilst lower than the 103 we saw only a short while ago, is still insufficient to push gold to all-time dollar highs. Now, we also, of course, have what we deem other major competitors to gold, and that is, of course, government bonds and equities. As investors predict that interest rates are still likely to fall further, and in many cases into negative territory, then government bonds, and arguably corporate bonds, but I'm focusing on government bonds, even with a tiny positive interest rate, becomes attractive, if only for their potential capital gain, as newer bonds are issued at even lower or negative rates. And of course, these being backed by governments, they're also regarded as safe. Now, despite recent falls, equity markets themselves have been buoyed by the level of liquidity and stimulus fed into the system. And although they are a fair way off their all-time highs now, they're still generally higher than they were just 24 months or so ago. So those of us who save, collect, or stack gold are in a dilemma. We often ask ourselves, are there better investment asset classes or vehicles out there? Is gold confined to the annals of history as just an inflation hedge? And if so, when will the true rate of inflation be reflected in the dollar value of gold? After all, if the debt clock is your guide, gold should arguably currently be standing at some $27,000 an ounce, when it's not even 10% of that. Now, what we have noticed over the years, and we admit it does not hold in every circumstance, but gold actually tends in the main to do better and perform more positively in a rising inflationary environment. Now, a number may argue against this and say, yes, but when prices rise, surely governments put up interest rates. And then, of course, the price of holding gold, which offers zero coupon, becomes greater, and therefore it becomes less attractive, surely. Well, that sounds logical, but does not often tend to be the case. But regardless of history, we have to bear this really fundamentally important fact in mind. The next inflationary cycle may be such that as prices rise, the level of government debt will be so high they simply cannot raise rates. Otherwise, exorbitant tax levels would have to be levied to compensate. Now, this has been the argument of the pumpers. The only difference being is that they keep suggesting that that time is now or tomorrow, just round the corner, and have been doing so for many years. Now, what this will then mean is that without raising rates, because they cannot afford to do so, the currency value falls, because there's nothing to make that currency attractive, and the monetary value of gold rises, and considerably. So when we are asked, when do we see gold prices really rising, and considerably, to use that phrase, our answer simply will be when we start to see inflation entering our economy on a positive uptrend. Now, we're all aware that the Fed is targeting 2% inflation. It would like to see that level of inflation, and currently it's considerably lower than that. And some may argue it will remain lower than that for some time. And others argue we may actually be entering a deflationary trend where rates could actually go below zero. Now, inflation above 2% may take a couple or few years to materialize, but it will eventually occur. In the interim, we still expect gold to hold steady and rise slowly over this time. But the large rise, in our view, will not really be 2020 and not necessarily 2021, though we will, we believe, see an appreciable rise. But by 2022 and certainly 2023, those who have invested methodically, moderately, and without paying over-the-top premiums will be most pleased that they have. Now, of course, in the meantime, if there is a major financial failure or a significant stock market collapse or a geopolitical event of extraordinary proportions, then that gold rush day will come sooner. Of course it will. The inevitable or an inevitable black swan event. But setting those aside, we are still of the view that we shall see solid prices with that rush forward on the horizon. Not quite yet, though, within short-term walking distance. What do you think? This is a reflective comment today, and we would like to hear your response to it. Thank you so much for listening. If you haven't already done so, please subscribe to our channel and press the bell sign so that you are notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.